And this time, now the Nigerian equities market is up about 32.7% in the year, while yields in the bond market have been relatively quiet, at least recently, now trading at around 12% levels. Now, for a look at how fund managers are investing across securities, I'm being joined in the studio by Michael Oyebola. He's a managing director at FBN Capital Asset Management. Thank you so much for joining us. Let's start with, we're in October now, we're almost at the end of the year. Let me ask you, as a fund manager, how has it been in terms of balancing your portfolio, all the headwinds that we've seen from the equities markets down to this fixed income market, especially how the financial regulatory environment, the shape it's taken since the beginning of the year?
It's been a challenging one. At the beginning of the year, we were bullish on equities. It's lived up to the expectations, but soon thereafter, the reporting season for Q1 and year-end 2012, the market is high, and then everything, well, just stabilized from there on. From our perspective, there had to be a risk premium above fixed income for us to continue to hold positions within the equity space. The moment Q2 results started coming out, we started taking profit, and I think for this year we've held still, but with the Q3 results coming out now, whatever we do would actually be either to sell or just hold. Now, we are long-term investors, especially in most of our balanced portfolios, but we have to see substantial upside on the equity market for us to move away from fixed income. So we have shifted a bit into the fixed income space, yields at about 13.5% on the bonds. Treasury bills have actually come off. The short end of the treasury bills are now at about 10.5, whereas the long end, you're still getting 11.5, 12. So from that perspective, asset allocation is now skewed more in the fixed income space than the equity space.
But you can look back and say, okay, at least for the first, maybe first quarter, part of the second quarter, when we saw that big rally, where we saw the Oceanics hitting 40%, yes. You would say that, yes, you did have a good time as it were at that time.
We did have a good time. We did have a good time. The FBN Heritage Fund actually had a very good year. It has continued to. It's a balanced fund, so even the returns I actually give you now may not compare to the NSC. The Heritage Fund is up about 14% at the moment, and that's up till yesterday. And that, we believe, is a stellar performance because it actually has a benchmark of 10%.
Now, for the equities, were there stocks perhaps at the beginning of the year that you saw that you thought were promising, held a lot of promise, perhaps based on fundamentals, based on past quarterly results, and then as the year went by, for some reason, they lost their appeal based on the same factors? Yes,
there is. I mean, we look at it from an economic perspective, and we thought the banks generally would actually, from the perspective of where they are, generally push along with the economy. But with the regulatory headwinds that were actually brought in, whether in terms of COT disappearing or the CRR being raised recently, we've actually just become about neutral on that. We are still bullish on the building material sector, but then we were also bullish on the agricultural sector. If you look at the likes of Presco, for example, but then if you look from international perspective, the prices of palm oil started coming down. So from that perspective, we basically had to take profit on some of those. So building materials we're still a bit bullish on. The banks were a bit neutral on. Now, but that says the top-tier banks, we believe they're resilient enough to actually change their business model and adapt, right? It is some of the other ones that we have to watch very, very carefully.
So you won't be adding any tier 2s to your portfolios? Or
we won't be adding. We've got some of them there. Some of the tier 1s are still giving you an ROE in excess of 20%, right? If I can only take a client's money and invest in a risk-free instrument at about 12, 13%, and a company can give me an ROE in excess of 20%, right? I may be able to trust their business model to deliver that to them, right? But still, I have to diversify, but I'm still more comfortable with the first-tier banks.
So obviously, the way the strategies you employ, the way you diversify your portfolio depends on the kind of class of clients that you have.
That is correct. Predominantly, a majority of our customers are still risk averse. Sometimes they don't even know it. About 80% of our funds under management, which is 86 billion as of yesterday, is in fixed income. The other 20%, they're prepared to take the risk. And what we try to tell customers is know what you need to do with your money. Don't invest money that you need tomorrow in a long-term instrument, right? Invest it in the short-term instrument. For FBN Capital, we have products that can actually accommodate everybody, from a money market fund to a fixed income fund to a balance fund. So for that perspective, we cater for all customers.
Okay, well, that's good. Well, you obviously overall sound bullish going forward, especially into the new month, and I suppose you've had a good year so far.
The Nigerian economy should peter along. I know that the rest of the world is beginning to catch up. I think earlier this week, the UK said they're doing 0.8 in GDP. Nigeria is still growing at about 6.5%, and we are still bullish on